So today we're talking a little bit about third city markets. We recently released a white paper called Third City Markets, the Emergent Trend in Third City Markets. And the idea here was, why don't we take the same methodology that we use to identify the next secondary and tertiary markets in the Western US that we're expanding into, where the greatest opportunities are. Let's take that same methodology and bite size it down to populations of 100 to 200,000. Now, we operate anywhere from 100,000 all the way up to 5 million population, metropolitan population. But we decided with this white paper, let's take that same methodology and let's just look at the smallest of the small markets, the almost beyond tertiary, and what is it? What does it yield? What are some gems along the way? Mm-hmm. And so that was kind of the exercise, and would love to you maybe talk a little bit about how we went about doing this.
Let's start with the idea that what's an interesting thing is that for our style of investing in secondary and tertiary markets, you have to earn your way into tertiary markets. You have to earn your way into the smallest markets. Those are often the hardest markets to enter. They tend to be the least liquid, which is the downside. Mm-hmm. And to buy at great pricing in those markets is difficult. They're just dominated by local players. And those local players tend to hold 10 years, 15 years. They tend to not sell. And to earn your way into tertiary markets, you have to be active in the secondary, create traction in those around it, and work your way into those best tertiary markets. And this idea of third cities, it started in Colorado. And it's interesting to note that this third city idea is an R&D idea. This was our applying a methodology that we have put on secondary and tertiary markets, and we tried to put it on the smallest markets. But this idea originated with Pueblo, Colorado. And if you ask Coloradans about Pueblo, I've gotten very mixed responses, but they have to remember that we live in Modesto. And frankly,
And we like Bakersfield.
So when I got to Pueblo, I thought, this is heaven. Like Pueblo, Colorado, they have a river. The Arkansas River goes to the middle of this place. It's a nice downtown. I thought, this is great. I've since talked to other Coloradans. They're like, Pueblo. But the point is this. You've got Denver, which is a dominant secondary market. It is a well-ranked and well-received secondary market throughout the U.S. And then you've got Colorado Springs, often ranked as the third best place in America to live. And then 45 minutes outside, you have Pueblo. The question was, especially in multifamily, what drives Pueblo? And the answer is it's in the vein of what drives Modesto. It's value and its proximity and its quality of life. Back up a step, the way we invest is we look for tight vacancy, reasonable rents, and value relative to replacement cost. And the reason Pueblo popped up was vacancy of 1.3%, rents that were about $1,000 a unit, and replacement cost at about 50%. Like, that showed up. Those are three green lights. You don't see those lights in Colorado Springs that way, and you don't see them in Denver Metro as much either.
Well, and I think even just stepping back a little bit, like you were referring, we are, by our very nature, we're contrarian investors. We're investing in geographies that are historically, non-institutional geographies. And to do that, we have to clear away the clutter, because you take a market like Bakersfield, if you talk to anyone from the greater LA area, Bakersfield is the armpit of the world. And yet, by many quality of life measures, by affordability measures, by climate, there are a lot of benefits to Bakersfield. It just happens to be shadowed by a much larger major market. And so when you have that kind of echo effect where it's like Colorado Springs is an amazing market, so compared to that, Pueblo doesn't look so great. What we use qualitative or quantitative measures to clear away the noise and be able to really distill down what drives a market and what are the key attributes of markets that we look for, regardless of perception and that sort of thing, because that's subject to to whim, and it's subject to, qualitative factors.
Yeah. It's interesting. If you have tight vacancy and reasonable rents, you will see rent growth. There is a list of people looking to rent those units.
Yeah. And if you have positive population growth, you will see continual demand in those markets.
So the markets are punished because of liquidity. Especially in downtimes like we're in now, it's a good time to buy, a bad time to sell. They're more cyclical, but the population's very sticky. Another piece we added into this was median home price, average income, rent compared to income, and ARP score. ARP's got this great score oriented towards seniors, but it's oriented towards quality of life. It's oriented towards affordability. And there's a lot of markets that are in the middle there that, because of value and proximity, score well than the most attractive markets, the famous markets. And a big part of our job is to not run with the herd. I'd say, use an analogy, dance with the herd a little bit. We're in proximity. We're not in the same strategies, but we are very careful of where our proximity is. And these tertiary markets, these third city markets, are a good example of how we dance. Does that mean we're going to be very focused only on this? No. We will buy in some of these cities. We certainly won't buy in all. We'll probably buy in a few of these cities, and it will happen over time as we build out our clusters in such a way that our management capability and our conviction and our thesis align with the right opportunity at the right time.
Yeah. So I'm curious, obviously I've seen the white paper, but maybe you could talk a little bit about some of the results that we found and some surprises and when we apply a more quantitative approach to evaluating.
Yeah. So we sorted first for vacancy rate. The vacancy rate in these markets are somewhere between 1% and 3%, the tightest in the country. Very hard to find that. Rents that were very reasonable, $800 to $1,400, especially relative to average income. Above average annual rent growth. Median home prices that were fair, but also made it make more sense to rent, or certainly there was it didn't favor towards owning. And most importantly, an ARP score, I won't say most importantly, but an ARP score, a quality of life score that said, this is a place where you can live. This is a place where you can raise a family. This is a place where your kids can go to school, where you're near nature, where you can probably have a garage if you want, where you can park your car and walk to a store.
So it's quality of life relative to affordability, essentially.
Yeah.
Because we're not looking at, the cities that score the highest on the quality of life are often the least affordable.
Right.
And so one of the key filters for us is because we want that ability for rent to grow.
Yeah.
We want that ability for property values to grow. And so being in an affordable market that also has quality of life, there's value there.
Well, these markets are the most open to institutionalization because there's the least amount of institutionals there.
Yeah.
These are hard markets to enter and require they're higher. It's contrary to what you might think, but they're high barrier to entry markets, both because it's hard to find the right deals there and because it's hard for firms to make sense of investing there unless they've earned the way to it by building out the clusters that support their management teams and their effort. It is a longer-term strategy, not a short-term strategy. But when we apply our techniques and when we run properties professionally in these markets, there's tremendous upside because they've been run by mom and pops.
Yeah. What city was most surprising on the list?
Cheyenne, Wyoming. 1.3% vacancy. Also Redding, California, Bakersfield, California, Yakima, Washington, Las Cruces, New Mexico. Based on this report, I went to Las Cruces not too long ago, and a lovely place. So, but I met with local firms there. I surveyed the market. Very tough market to enter. It's very tight, entrenched market with local players with local players. So to a larger market fact, the largest market that might fit this is El Paso, 45 minutes away.
Yeah.
And there will be a day, I think, where you can combine those two markets in a cluster.
I think something to mention about this white paper, much like our prior white papers, it's a mix of tactical, real-world investing experience with kind of maybe our more academic, analytical approach of how we view the world. Going back to the whole contrarian investing, it requires a discipline and a quantitative approach that kind of working with the herd doesn't necessarily require.
I mean, you work primarily on the capital side, or you lead that side. How does this strategy resonate as you see it on the capital side?
Yeah. Oh, absolutely.
It must be an interesting pitch.
Yeah. It is fascinating because, the conversations are pretty binary in like, I totally resonate. I get it. This is an opportunity, or I don't get it. This is not something that we're interested in.
Yeah.
And I would say on the get it side, it really is around, I mean, candidly, everybody is searching for alpha. Everybody is searching for the next niche strategy. They're looking for where they can find pockets of opportunity in the market. And I think as we have seen, there's this large, mature, existing segment of the market that is there and has yet to be institutionalized. So this isn't, I would say with life science, it's a little bit of maturing a category, but also inventing a category, right? Because it's a new field. Data centers even more so. It's a new category, right?
Yeah.
And so people are learning how to operate in those categories. But secondary and tertiary markets, like a lot like self-storage or mobile home parks, it's just an existing mature segment of the market that hasn't been institutionalized. But when you do that, it requires a more methodical, quantitative approach to entering these markets because you're by your very nature, you're going into highly inefficient markets.
The most inefficient.
That have not a lot of information flow, and you're creating the systems to build that information flow.
When you're just talking about an individual market or two, it's easy to see that as not the strategy. But when you speak to the greater Western U.S., that there's 85 secondary and tertiary markets, $1.8 trillion worth of value in the multi-tenant industrial and value-add multifamily that we invest in. The aggregate value, the aggregate opportunity is what's extremely powerful. So what on our side becomes the most powerful thing is the way we develop new markets, the way we build clusters, the way we develop over time into lots of smaller markets that historically have been untouched because it was inefficient to go there. We are putting in the groundwork and the capital and human capital to develop into those places. Yeah. So I just close by saying what's next for us? What's next is we'll continue to do this sort of R&D. We will continue to build out the clusters in the 7 markets we're currently in. We will likely add 1 or 2 markets or sub-markets per year. And we'll do this for a long period of time. And we expect to create a lot of value.
Thank you for listening to Durable Value, an investors podcast, where we demystify commercial real estate with safe, sound investment strategies to help you balance your portfolio. If you enjoyed this podcast, be sure to rate it on iTunes or wherever you get your podcasts. To learn more, visit GresetaPartners.com, where you'll find more information, investors' tools, case studies, and more. This podcast is hosted by Joe Muratori and Ryan Suela. It's produced, edited, and mixed by Melodic, with intro music by Ian Post. Thanks again for listening, and we'll see you next time.